Hope you guys had a great Thursday. Let's go ahead and jump right into this aftermarket brief. So we see the crypto market is in the red and the averages pulled back just like international markets, and how our chart analysis predicted earlier this morning. We had the Dow Jones sitting at a negative 1.2%. We have the S&P sitting at negative 1.23%, and we have the NASDAQ sitting at negative 1.59%. So a pretty heavy down day, which is expected. If you have been paying attention to my post on IG and Facebook last year, right before we entered into the new year, what did I say? I said that over the past 2 or 3 years, what has happened generally from about December to about March or April has been a total market pullback. And then around March or April is when the market begins its push back to the upside. And I took that to heart today, and I did a little bit of research into some of the stocks in my own portfolio, which I hold 87 right now, but we only had about a few that went green on the day and most that pulled back red. But there are a few stocks, a good number of stocks in the portfolio that has performed well in the first 2 months of this year. Now, looking at some of these charts, what I noticed is that what they showed was a push back to the upside in either January or February. So December would be a bit of a pullback. And then in January or February, we would see a big candlestick that pushed back to the upside. Let me see if I can find an example of one that shows that on the monthly time frame. So yes. So as you can see on this is a lot here. So what we see here is in January, the candlestick is very small because we had a big push in January, but then it all went away at the end. And then we had this bigger green candlestick, larger green candlestick that shows a big increase at the beginning of February, which we haven't even pushed into the full first part of February yet. But in general, this pattern, a small either January or December candlestick, and then a push into January or February, has been typical in a good number of stocks that I'm narrowing down right now. But I got a lot of metrics to get down so that I can find the stocks that we can seasonally, or that I can seasonally invest in around the year at certain points, so that I get the best profit and the portfolio performs the best during those different seasons, because everything's always moving. I also found a few indicating stocks that show when there's going to be more than likely a recession or other things that may pull the market down. But other than that, what I did today was we had Affirm release their earnings, which was huge. They did phenomenal on the year. They beat on earnings per share, which is what the investor gets paid. And they beat on revenue, which is positive. In the aftermarket hours, though, it was similar to what has been happening with most stocks over the past earnings seasons, at least the first quarter of each year. Typically, earnings seasons, even last year, was very solid. Companies were showing that they were making profits, that they were doing well, and that the consumer was still strong, yet and still they pulled back. So seeing that similar pattern this year, I know that it's just a setup for March or April to push very, very hard. So right now, there's going to be a couple stocks that I'm going to be isolating and diving into and buying or averaging down in within the portfolio. Other than that, other big points in the Affirm release is that they say that the consumer is healthy. Now, Affirm is a buy now, pay later, so they do limit their service to people who have good credit worthiness, but in general, they offer it to blue collar workers who don't have too much access to certain credit options when it comes to extending payments and things along those lines. But I'm going to leave a clip of some of the audio from that earnings call that I listened in on, which was an hour long, but it was great information and great answers, great depth of information given by the CEO, the CFOs, and those involved with that presentation. But other than that, one other thing I want to note when it comes to this buy now, pay later scene, FICO, one of the major players in the portfolio that has been pulling back heavily over the past few months, they just released a few articles on some of the work that they're doing in Southeast Asia. I believe they partnered with Grab Finance in Southeast Asia. And basically, there's a large region or a large number of people who are just unbanked because they don't have either pay stubs or all the required information that's typically needed when it comes to getting involved with credit or getting credit for payments and things along those lines. But what they did is they partnered with Grab Finance and they integrated their data software into the Grab Finance system, which is similar to, I believe they employ people like Uber and Lyft, but they implemented their software into that system so that those people who are typically unbanked, through the payments that they get through that system, through the travels, through their traveling, through their spending habits, because I believe there's probably a card or something that's connected to that payment system from Grab Finance for them. But through that, they were able to develop a profile for those customers who are typically unbanked and don't have access to credit or loans or anything along those lines, payment plans and things along those lines. And they were able to provide them with credit and credit history and get them access to bank and banking services. So that was a phenomenal article that I read today. They dropped about 4 or 5. They also talked about how they partnered with HBCUs recently, and they have been pursuing that or pushing that program to be more prominent in their development of gaining more interns and growing the data scientists industry. But other than that, guys, I believe there's not too much else that I have for you today. I'm going to leave that clip or that audio recording of some of the clips that I got from the Affirm earnings call in the last part of this video with a little music. Maybe it'll be interesting to you, maybe it won't be, but for those who are nerds and who like information, in-depth information and an idea into how the CEO, CFO, and how the business operates in that transparency, it will be there for you. Because when you're investing, you're not just looking for a stock price to go up. You have to understand the company, the business, the metrics, not in extreme detail to a master's degree level in finance, but to somewhat of a degree that benefits you and gives you the vision to be able to understand if you want to keep your money in that business and in that stock, or if you want to move it to another position. But other than that, guys, I hope you have a great Thursday, and I guess I will see y'all tomorrow morning to prep for Friday. Have a great day. Peace.
The very short answer is we're building a network. Like, Visa is accepted everywhere, Amex is accepted everywhere, etc. We see ourselves as a 21st century version of American Express sometimes, and the goal is to be on every convenience store door and all the doors, all the online doors, all the offline doors. Affirm wants to be the universal acceptance mark.
I was wondering, Max, if you could give us an overview of what you're seeing out there in terms of consumer trends, credit trends, overall economic health. It's such a tumultuous moment. And maybe also comment on what you've seen sort of quarter to date.
So the one-liner answer is the consumer we see today is quite healthy. So they're able and willing to pay us back. They're borrowing money. Obviously, the growth numbers are out there in the sprint. So we are not seeing, again, our consumer is now reaching quite a large subset of North Americans and growing nicely in the UK, but we're not everyone. We don't always say yes to a loan, so it's a little bit selective, but we feel pretty good about both the demand and the ability and willingness to repay. We are probably in one of the noisiest environments as far as information headed for consumers' heads, maybe ever, certainly in my lifetime. Like there's news every day, and some of it reads like science fiction, and some of it is science fiction, or at least slop. And so you can have a deal, and here's 5 paragraphs of explanation when it's valid, and it's 5%, but only if it's Tuesday, and like all the sort of promotional go-to-market that we're seeing from a lot of our competitors just doesn't seem to make a dent in what we sell, which is always like on the nose, brain dead simple. You are getting no interest. If you buy this thing, you can split it into 12 parts or 24 parts or 6 parts, and you'll pay no interest at all. Like 0% sells as well as they do, not just because it's free money or free loan. It's because it's so easy to understand. And the thing that we've built over the last decade plus is when a firm says no interest, we actually mean no interest, and there's no asterisk, there's no explanation as to what might happen if you are a penny short or a day late. And so our calling card has kind of become our moat, has become associated with us, which is a inherently defensible position. We don't get into conversations with merchants around what if it's 0, but it's not really 0. Like there's a lot of sort of details to hash out if your offers are not super crisp and transparent, and that's exactly what we do. So we've always been pretty clear. There kind of 1A reason to have a bank charter is regulatory certainty. You operate as a bank partner, you want to know that your bank partner is on excellent footing, that there are no hidden rocks for that particular bank. And if you own a subsidiary, you would presumably understand it a lot better. And that's the primary motivation of why we applied. Obviously, the climate at the regulatory bodies that issue such approvals is changed, and that's something that we track very carefully. The timeline is certainly years, so I would step away from any model modifications. We don't know if we get approved. We don't know exactly when we do, if we did, and there are all sorts of timelines that are prescribed by the approver to prepare, then to open, then to stay in a de novo period, and then finally to operate sort of with fewer restrictions. So it's definitely a long-term investment in regulatory certainty. Down the road, you can start imagining products that are only possible with a bank charter in your available tools. That's so far away, it's really not worth talking about right now. But it is a great investment in our regulatory stability for the years to come, assuming it actually ends up in the approved category.
One, on the AI, that was a big surprise. I just want to know how much of this AI boost is actually contemplated in the guide and if it's fully rolled out. Thanks again, and great results.
It's definitely early days for the Boost AI. I was trying to sneak into the letter exactly how few merchants have adopted Boost AI. Adapt AI has been around for a couple of years. It's, generally speaking, batteries included, part of the product. Boost AI is new, and it's super cool because it does automated A/B testing, but it also has a channel. It is a channel for incremental merchant dollars. Like the thing that's I tried to describe and ultimately got edited down a little bit more. Boost AI allows a merchant to say, you know what, I have $100,000 more dollars I'd like to put into Affirm specific promotions, 0% or just reduced APRs. You guys go and A/B test who would be the most likely to convert with that kind of offer in front of them. Go deploy it. I don't need to know exactly what happens. I just want to maximize my dollar for dollar investment into sales. So it looks more and more like an advertising model versus a cost of acceptance model, which is exciting because it just gives our machine learning engineers a lot more freedom to really do some amazing things for our merchant customers. So super excited about the product. It is pretty early. We're not breaking out what it does for our numbers. So it tells me Rob. So the card is just continuing to grow very quickly. GMV year over year for the quarter we're reporting was up just under 160%. Active cardholders went up 121%. 0% deals on the card went up 190% year over year. So like it's not the only growth engine, but it's a big growth engine for our metrics, and it's now material to the overall business. It's no longer a kind of a cool novelty product for our diehard users. It's helping us create more diehard users. So the card is doing really well. We have a lot more planned for the card, so we don't intend to slow it down, if you will. International, I don't know if you saw, we announced a couple of really nice deals in the UK specifically. A couple are US brands lighting us up or saying that they will light us up soon in the UK. So and obviously Shopify announcement was a little while ago. That's scaling. We're still actually not at sort of peak run rate there. So we expect to improve those numbers. Wayfair, we just announced literally a couple of days ago that we are live in the UK in the bit of a beta, pre-beta type thing, but that's going to scale up, and they've been our partner in the US for a very long time. We have a bunch more. Vimo 2 is obviously, I think it's the largest, or certainly one or the first or second largest device company, device selling company in the UK. So we announced that. We have a whole long pipeline of sales happening there, and we're excited about that. So, and then there's more countries to come for sure. So both international and the card are still significant drivers. The card is much larger than international. International is now growing consistently at a pace that excites us.
Could you just comment on what you're seeing out there in the regulatory environment? Like, are you hearing anything about potential caps on BNPL rates? And, if so, how would Affirm react to that?
Definitely not hearing about potential caps on BNPL rates specifically. Obviously, very dynamic set of conversations happening at the federal level about credit card rates. One good rule of thumb about regulatory realities, if you will, whenever Republicans are in the White House, you can expect more attentive and active attorneys general from all 50 states, both red and blue, because they feel that you would expect a more relaxed posture by the federal regulators. And whenever Democrats win the White House, the executive branch starts puts more attention into various laws and regulations at the federal level, and then the state attention typically fades a little bit. And it has as much to do with the employment of the people that work in these agencies, both at state and federal level, and the overall posture of the various political elements we have. And so right now, just from a practical perspective, obviously we're tracking all the things, both federal and state level, have an active conversation with all of our regulators, generally speaking, have positive and constructive relationships with them. Doesn't hurt that we don't charge late fees, don't screw our customers, typically do the right thing in as much as we can, and then some. So nothing sort of too exciting to report. Obviously, we felt compelled to apply for a industrial loan company bank charter. So clearly we believe that the sort of really grown-up regulators, FDIC in particular, we expect them to see us as a good actor that's prepared for the big leagues or the beginning of the big leagues. So generally speaking, feel pretty good about it, but we are always regulated. So we're always regulated by 51 distinct entities, federal and 50 states, and that's part of the job. The gains in cardholder growth outpaced the gains in GMV, which is kind of interesting. The card grew even better than the GMV. So all of that was really solid. One thing that's worth knowing, it's not in the question, but it should be, we have really good evidence, just lots and lots of months of data showing that folks that come in through a 0% APR loan are quite happy to use us for both interest-bearing and non-interest-bearing products. There's a sort of an industry myth that you self-select into an APR and then you react violently when it changes upwards. That is not the case with the Affirm consumer. And you can sort of debate exactly why, but it is factually correct that people who sign up with a 0% deal do not mind other offers that we give them. Because it's so effective, we're obviously very hard at work telling merchants about it. On the Intuit side, that's actually super exciting, and it's not B2B. What it is there is a whole facet of the services world that gets billed through QuickBooks. And until just now, or whenever it launches, you would pay for these services with a credit card. The service provider would tell you it's going to cost you $5,000, and off you go. You decide if you want it. as soon as we launch, which is in a fairly accelerated timeline, the service provider will tell you, I can make this $5,000 over the course of 6 months. All you have to do is use Affirm. You already know the name. It will be in your invoice. And so it is the usual Affirm, if you will, B2B2C. Intuit is a fantastic aggregator of small service providers, businesses that bill consumers. We will be included in those invoices, and the consumer will be educated that they can pay over time for these services. And we feel like we have unlocked another side of transactions that until recently were just not exposed to buy now, pay later at all. So super excited about that. And there's a lot more to do there, but that's the first step. The way we choose new categories is entirely based on consumer pull. And because we have a card that works everywhere Visa is accepted, we get a really high fidelity daily print of, oh, check it out, people are using this for this thing. Well, that's interesting. We should maybe talk to some of the people that sell whatever that thing is. And we knew that auto parts and adjacent things has been a huge component of our growth for a very, very long time. It made a ton of sense to go talk to people that sell auto parts and ask them, okay, so if we integrated directly instead of having our consumers come through the card door, what would that product look like? Would there be a reason for us to do something a little bit deeper? Would you be interested in sponsoring zeros, et cetera? So that's roughly how we pick new categories. We think that we should not be the only people issuing debit cards with buy now, pay later capacity on them. And there's already on the order of 500 million debit cards in America, and many, many, many banks where people bank locally have a debit card, have a banking brand they love and don't feel like switching out of, and would love to see buy now, pay later capabilities from their bank. Their bank, on the other hand, does not have a software engineering team or an underwriting team or capital markets team. We do. We are excited to offer our platform to anyone who wants to be on it. The best way of reaching some of these folks, given their technical limitations, is through their core banking software providers and their integration teams. And that's what we're trying to do here.